I'm excited for today's event. Some of you may know Jennifer Baker. If you attended our May Summit, she did a great presentation there, and she's going to continue that today. Jennifer is the owner of Baker Wealth Strategies, and she has just a, an immense knowledge of your side because she's got the CPA background, but she's also the financial advisor side too. So she does a great job in really bringing the two together, which is one of the reasons I love having her share her knowledge with you. And today she's going to share the three impactful tax strategies for high net worth clients with you. And I've seen this before. You guys will get a lot out of this. And so, Jennifer, it is an honor to have you on. Excited for you to do this today. I will turn it over to you and let you get started. Thank you.
Thanks, Dave. Appreciate it. Let me share my screen here. Okay. There we go. All right. Can everyone see that okay? All right.
Yep,
Okay.
looks good. A lot of yeses.
Thanks.
Thumbs
All
up.
right. So like Dave said, this is a presentation I did on the Tax Plan IQ webinar not too long ago, but I only had 20 minutes last time. So I wanted to be able to go in a little bit deeper to some of these topics and also save time to answer questions. So like Dave said, I am a CPA. I do not prepare any taxes. I leave that to you guys. I find it much better to partner up than to try to get into that world. So I will introduce the team. We have a small group, and I think that that's an advantage because we can come in and work with you on the back end to present a unified team to your clients. I think the higher net wealth clients, they tend to want their advisors to talk on the back end. They don't want to be the one who's trying to coordinate the strategy. They want someone to present to them and just say, here are all the aspects, and we've got it all covered. So that's what we try to do, is come in and partner with you. We don't want you just to refer people to us. We want to work with you and be a team. So the three strategies I'm going to go over today are cash balance plans, key man policies, and planning for estate tax. So the cash balance plan we'll start with. This is one of my favorite strategies. This is for your high net wealth clients who need huge tax deductions. So this is something that people hear a lot about, defined benefit plans. And I think that there's a lot of old information out there. Usually when clients hear about defined benefit plans, they'll say something like, oh yeah, I've heard of those, but I don't want to commit to something for 10 years. And so I think for this cash balance plan, you can think about it like a modern defined benefit plan. So we're taking all of the good things about a defined benefit plan, and then we're adding in some flexibility. So this is for your business owners who can put 100,000 or more away a year. So this is not for all of your clients, but these are the ones that you're trying to really make an impact on that tax plan. They have huge tax liabilities, and the workhorse strategies are great, but you need something more. So this is where you can turn. And a cash balance plan in its simplest form is just a qualified plan. It's just like a 401k, but you can put a lot more in. It's a lot more powerful and flexible. So these are all employer contributions. So it's similar to a SEP in that aspect, except for instead of having to do an equal amount to all your employees, we can really design this plan to skew it towards the owner and make sure most of the contributions are going towards the owner, still being compliant, still having some go to the employees, but we really have the ability to be flexible there. We can also be flexible in how much they fund each year. When we design a plan, we usually design it for 10 years. But if you say, hey, my business owner is going to retire in 5 years, we can always design it for 5 years, or 5 years in, we can just end the plan. So there's a lot of flexibility, not only for how long they do this plan, but also for how much they fund each year. We'll have a goal for how much we think they're going to contribute each year, but we can always freeze the plan. We can lower the amount. There's ways that we can increase it. If they have a really good year, we can increase their W-2. So there are lots of ways that we can scale it through the years instead of having them locked into a set amount each year. We can do these all the way until they file their taxes. So that means that you can still implement these for 2024. So if you have a business owner who still has a tax liability for 2024, we can go back, do this cash balance plan now for the 2024 tax year, and they can still get that deduction and get a refund. So the different parts to this plan, there are quite a few accounts, so I want to kind of go through this. The 401k and the employer match, those are optional. They can either be added into the overall plan or they don't have to exist. So the cap can go on top of an existing 401k plan, or we can set up both together. The reason they might want to do a 401k or if they want to do something for their employees. The cash balance plan is going to be all employer contributions. So if they want to have the ability to let their employees set aside money for their own retirement, they would need to have that 401k side. The business owner could still deduct money from their paycheck if they wanted to on that 401k side, and then all of the rest would go towards that cash balance plan. So in the cash balance plan, we have the profit sharing. That's going to be in addition to the 401k match, and that will be where most of the employee contributions go. So a profit sharing plan is a defined contribution, which means they'll put money in for their employees, and then whatever that money grows to, whenever the plan ends, that's what the employees get to take. What that means is that the employer is not on the hook for a certain amount. So that's the other part that people are a little afraid of with defined benefit plans, is that they're on the hook for delivering a certain amount to their employees at the end. This profit share plan can make it to where they're compliant with the overall cash balance plan, but they're just limited to what they put in and whatever it grows to for their employees. On the defined benefit side, this pension account is where most of the owner's contributions are going to go. And so this will be an investment account that, that we would manage in accordance with the plan. They can really take as much risk as they want with those investments. We can go for growth if they want. The only downside would be if we grow the assets too much, then they may not be able to contribute as much to the plan later on. In years 8, 9, 10, it may cap them out. So if they want to keep those large tax deductions, we may need to keep an eye on that growth and make sure that we don't grow the assets too much. This life insurance, this is where the other part of the owner's contributions will go. We split it between the investments and the life insurance. The reason that we use the life insurance is because we're trying to avoid putting all the money into a tax deferred account that they're eventually going to have to take out and pay tax on later. By using this life insurance, we can take money that they've gotten a deduction for, they put it in their tax deferred bucket, they fund the life insurance within that tax deferred bucket, and then in year 5, the owner will buy that policy out of the cash balance plan, and they get to do that at a discount. So you can think about it like a Roth conversion at a discount, where they've now taken money that was going to be taxed later, they've moved it over to that tax-free bucket at a discount. So it's a really powerful exit strategy for this plan. And so that's really the biggest difference between kind of the old defined benefit plans and these new modern cash balance plans, where they can have that insurance in there and really get that tax efficient strategy on the back end. So these are some of the reasons why we include life insurance. You can actually contribute more to the cash balance plan if you're going to be using life insurance inside. The IRS values life insurance differently than it does investments, so it's a way to get more in and not hit that ceiling for the defined benefit plan. You can use these tax deferred dollars to fund the life insurance, which is a really big deal because you can never deduct life insurance premiums. So by getting a deduction for funding the cash balance plan and then allocating those funds to the life insurance, it kind of feels like you're getting a tax deduction for that insurance. And then whenever they purchase the policy, they can either purchase it personally, where they'll own it for themselves and then be able to use that tax-free income later, or an ILET can purchase it. An ILET is a big planning tool if they have a taxable estate, if we have to worry about estate tax at some point. If they need to get it outside of their taxable estate, the ILET can buy the policy and then it'll be outside of their taxable estate. And then the other thing that it does is it provides an opportunity for early access to these funds. Once they buy out the policy in year 5, there's not the requirement to wait to 59 and a half to use those funds from the insurance policy. The cash balance plan is a qualified plan, so they have to leave the money in until 59 and a half. But the life insurance is a way to have access to those funds early without having a penalty. The ideal client for a cash balance plan is going to be a high income business owner. It doesn't matter what structure the business is. It can be a sole prop, it can be a C corp, it can be an S corp, a partnership. It doesn't matter, but they are going to need to be able to commit 100,000 or more annually. So it's got to be somebody who is making a good amount of money. They need to have a consistent cash flow, because even though we're not locking them into a set amount each and every year, we do want them to plan to fund it for 10 years. So if someone just has 1 year that they're going to be able to fund it and then they want to end it, they can, but it's just not ideal for the efficiency within the plan. You do have to fund for your employees, so we like to see a low employer to employee ratio. That kind of varies because there are some ways that we can design the plan to try to avoid giving too much to employees. So it's not a hard and fast number. It really depends on how old the employees are, how much they're getting paid, if there's ways that we can exclude certain employees. If employees are if they're making a certain amount, we can exclude them from the plan just because they're already highly compensated. And so the rules say that they're already being paid enough. They don't have to be paid in addition by funding this cash balance plan for them. And then we want the business owner to be probably 40 or above. We can do, there's not an age limit that you can't do the plan, but we have found that when we try to do these plans for people who are 26, 27, we just can't get enough into the plan to make it worth it. At that point, it's usually better to fully fund a 401k, do the SEP. There's other ways that we can get a good amount into a qualified plan without having to add the actuary fees and all the complexity for a cash balance plan. And then the last point is that cash balance plans can be used, we can do an off calendar year. So there's a way to combine 2 plan years into 1 tax year. And so if somebody's selling their business, this could be a really good way to bunch those deductions and get a really large deduction in the year that they sell the business. A lot of times there's earnouts or other ways that they're still making money after the sale. So they can either keep contributing to the cash balance plan, or we could end it and roll it to an IRA at that time. And then a few other things about the cash balance plan. One is that if you have clients who are really low risk tolerance, they don't want to be aggressive, they're scared of an audit, there's plenty of reasons that people don't want to kind of play in the gray area sometimes. This is very black and white. It's a qualified plan. The rules are very clear cut. There's really nothing that can come back and be questioned about the plan. Even the insurance, the insurance company values that life insurance at year 5 at the buyout point. So that's not even a place that there could be risk. It's whatever the insurance company says the fair market value is, that's what we use for the sale. And then if you're not going out and doing full tax plans for your clients yet, maybe you're new to tax planning, or maybe you've got all your compliance clients and you just haven't been able to incorporate full tax plans into your practice yet, this is something that you could just add on top to clients, even if you're not doing a full plan. This could just be a one-off for those really high business owners. And then it could be additional revenue for you, since our tax professionals for their time and their tax planning, because this is complicated and we need you guys consulting with your client, showing them how it works within their overall tax situation. And so we pay you for that time. So it could be additional revenue for you there. Okay, I have a couple of case studies. The first one is it was a husband and wife, and they had 9 employees. They had made $5 million that year, so they wanted the most that they could put into a cash balance plan. So they wanted to maximize their tax deductible contribution. They wanted to keep their employee costs as low as possible, and they wanted to leverage that tax-free income. So what we were able to do for them, so this top line, this is the husband. He was able to put in almost 345,000. The wife was able to do about 60 because her age was lower. She's 50, and her wages were lower. We can only use W-2 wages from an S corp. So we have to split out whatever they make on the K1 is separate. We can only use the W-2 for wages for calculating how much the business owner can contribute. So in total, with their employees and with some pre-funding, we were able to fund $573,000 into this plan. What that meant was they were able to save over $200,000, and their employee cost was just a little over $30,000. So the husband and wife, got to keep almost 95% of the contribution that went into the cash balance plan. They got to put that full $573,000 as a tax deduction on their return, and they were able to save over $200,000. The next one I wanted to show, this is pretty much the ideal client for a cash balance plan. This was one that one of our tax partners came to us in August. So they only had until September to fund this. And it was a doctor who had made over $800,000 that year, and it was all on Schedule C. So they were facing a huge tax liability. They're in California. They didn't have any employees. So it was really the perfect situation for a cash balance plan. We were able to fund $639,000 into this cash balance plan that he was able to deduct. He didn't have to give any money to employees. He was able to keep the full amount for himself and save over $300,000 because he's in California. So that was a huge win for that tax professional. They were able to come in. This was the first year they had done the return. So they were moving him to an S corp and things like that in the future. But there was really nothing else they could do for the previous year except for this cash balance plan. So it was a huge win. Few frequently asked questions. People ask if they can end the plan early. They can. You can end it for any business reason. Once it ends, the funds will just roll over to an IRA. They can invest the funds any way they want. So Baker Wealth Strategies would be managing those accounts for them, but we can take into account their risk tolerance and go as aggressive or as conservative as they want. And then if clients sell their business, if it's an asset sale, it can either be sold with the other assets, or they can retain the cash balance plan if they're going to be receiving an earnout, or if there's some other income sources that they're going to continue to have in that entity after the sale, and they could keep funding the cash balance plan. The process to implement is pretty straightforward. We'll meet with the client just to kind of go over a quick presentation. We try to keep it really short, like 15 minutes, because we know business owners don't have a lot of they don't have a lot of attention span when it comes to some of these things. So we try to just hit really high level what it is, explain how it's a qualified plan, give them an idea of what they can do with it. And then if they're interested, if they say that's something they want to do, we have to make sure they have the cash flow available to fund it, things like that. Then we'll gather some basic business information. We can either get that from you guys if you do their payroll, or we can ask them for a census. And then usually the tax professional will have just EIN, basic business information like that. We can create the tax proposal. When we get back together with a client, we present it. If they're interested, we can do all of the paperwork through DocuSign. It's a very easy process for them. It does not require much of their time. And then once we get it funded, we start the health rating process for the insurance. We get that funded. And then after that, we just have to meet each year to make sure that they're on track, see what they want to do as far as their funding, if they want to increase the amount, if they want to lower it, we can make those adjustments as we go. The second strategy I want to share is getting cash out of a C Corp. So this is a big deal because C Corps are taxed at 21%. So it's really appealing for people to want to elect C Corp status. That way they only have to pay 21% tax, but at some point they're going to want to take the money out of the C Corp, and usually they don't want to pay the second tax that requires. So this is a strategy to be able to get the money out without that second tax. So what we do is we fund a policy inside that C Corp. The business owner can, the business can buy a policy on the business owner as a key man policy. They're a key employee of their own company. So they can fund that policy with dollars that are in the C Corp for 5 years. They don't get a deduction at the C Corp level, but those are after tax, after 21% tax dollars that they can put inside that insurance policy. And so there is a benefit there. They use that money for 5 years, they fund it, and then they're able to personally buy it out at the discount, similar to how they can out of the cash balance plan policy, or out of the cash balance plan. The way we get that discount is the policy is structured to where as many of the expenses as we can accelerate get taken in those first 5 years, and then we delay the growth because it follows a 5-year S&P index. So we delay all of the growth to not hit the policy until after they've bought it out. So that policy has taken a lot of expenses and not seen any growth. And so that's why there's such a discount for that fair market value at year 5. So they're able to buy it out personally or an ILET if they need to. And then once they own the policy personally, they can use that income out of the cash value in the policy tax-free for whatever they want. They can fund a new business, or they can use it for retirement income, or pay for their children's education. There's a lot of things they can use that cash value for. And so that way they're able to get that money out because that policy is worth a lot more than they were able to buy it out at that specific point in time. So over the next 20 years, they're going to be able to take a lot more income out than they paid for that policy. So just a quick example, if they funded $100,000 for 5 years, they would have put $500,000 into the policy. If they took that money out of the C Corp and paid that dividend tax, then they would be paying $100,000 in tax when they took that money out. They buy the policy out for $300,000. So they move $300,000 cash into the C Corp. They take the policy out. So now if they take that $300,000 out of the C Corp, they're only paying $60,000. So they've saved $40,000 in tax by making that exchange. So this also does provide protection for the business. It's not like they're buying this policy and not getting any value for it. If something happens to the business owner in those first 5 years, the C Corp would receive that death benefit tax-free. So that would allow for them to continue payroll or continue business expenses while the family tries to sell the business, or whatever the plan is for that next step. But that gives the business cash. So there's that secondary benefit of having the death benefit available until the policy gets bought out. This can be used as a retirement plan for the business owner, and they don't have to include their employees. This is not a qualified plan, so there's no requirement to include employees. So they can do it only for themselves, they could do it for themselves, and one other key employee, they can make that decision. And this is a permanent tax savings. This is not deferring tax. This is using the tax code to the client's advantage and exchanging cash going into the C Corp and taking out that policy that eventually is going to be it's going to provide much more tax-free income than they originally put in. So it's a way for them to permanently save that tax getting money out of the C Corp. And we could see a lot more of this if QBI goes away. I know that it doesn't seem like that's going to happen right now, but we don't know. I mean, nothing's happened with Congress yet. So if QBI does go away, we'll probably see a lot of conversions to C Corp. And so if that happens, we'll need more strategies to get money out of those C Corps. My last strategy I'm going to go over is estate tax. This is something that doesn't get included in tax plans a lot, but we want our tax professionals to start using this because this is something that is not on the radar for a lot of people. The exemption is almost $14 million right now, so it doesn't come up with a lot of clients, but when it does, it can be a huge strategy for you guys, and you need to be putting it in your plans to get credit for it. Because it's not your fault if you don't ask about it or don't realize that it's an issue for clients, but it's going to be your problem. Because if a client gets a notice in the mail from the IRS, you've seen these notices right here. If they get a notice and they realize that they have to pay millions of dollars of tax, they're going to immediately call you and they're going to say, how did you let this happen? You don't want to have that phone call, and you want to be ahead of this issue. So if you think about it now, if you start talking to your clients about it now, it's something that can be an asset instead of a liability for you. So like I said, the current exemption is almost 14 million per person. So a married couple is going to be almost 30 million is going to be exempt from estate tax. So this isn't something that every client is going to have to deal with. But if you have a young business owner and they're successful, they may be worth $5–10 million today, but they may have an estate tax problem in the future, because it doesn't matter when you do the planning, it matters when the client dies. And we don't know what that exemption is going to be in the future. It's always on the chopping block. Every time there's restructure, every time there's a new bill. So we don't know. And so we just need to plan for it, at least talk about it. So that way you're protected if it ever does become a problem. So this is a quick example. If your client's 40 years old, if your client's 40 years old and they're worth 10 million today, even if we just conservatively estimate growth on their estate at 7%, at age 60, they'd be worth 40 million, and at age 80, 150 million. So even if the estate tax exemption stays high, I don't know that it's going to stay that high. And at a 40% tax, you're looking at a huge estate tax bill due. And so no one wants to pay $60 million to the government. So if we can do some planning now, they don't have to give up control of their assets. That's not the only way to get money out of your estate. Then we can do some planning now and save them millions of dollars in the future. So really the process is pretty simple. Just make sure you're asking for a personal financial statement whenever you do your intake forms. Just because a client doesn't have extreme income doesn't mean that they didn't inherit money from their family. Maybe they sold a business previously. They may not tell you these things, so it's just worth asking to make sure that that's not something you need to think about. And if they're worth over $10 million now, send us an email, let us know. We can set up a meeting. We have an estate planning attorney on our team. So the goal is that we would come in and help do the planning, and then we would bring in an attorney to actually do the documents. So we at Baker Wealth Strategies do not do the legal documents ourselves. So if you have an estate planning attorney that you work with, that's great. We'll still use them. So it's not a conflict. We just want to help do the planning part where we can work with you, make sure the tax and the plan is in place, and then we can go to the lawyer, get the estate planning documents we need, and get the client set up that way. And once again, we'll pay you for your time and your part of the planning. So when you bring that tax knowledge, that's really valuable. And so we'll be able to really set this plan up for the client so that they feel comfortable and confident that everybody on their team is working together. So just a reminder of our team, we have a very diverse team. So we're able to help whether it's, putting together projections for your retirement planning. We have college planning. Ashley can get on and talk to clients about what they need to do to get their child set up for the right financial aid and the right forms that they need to file. We have Justin, who is our estate planning attorney. He's worked with clients that are 100 million and more, families worth 100 million more. So he's very experienced in all of the estate planning techniques that they would need to use. And then we have Jamie, who's our director of investments. He also just got his cash balance plan certifications, or cash balance plan specialist certification. So he is the one that is our expert on the team for cash balance plans. And so we'll be able to help no matter what issue you have with your clients. We're able to do all things wealth management. So let us know if we can help with anything that you need. Clients are expecting more from you guys. They want their CPAs to be involved with everything. So we know that you can't learn everything there is out there. So that's what we want to do to help, is to come partner with you so that we can present that unified front to the client, but you don't have to spend a lot of time going out and learning everything about the estate planning world, the investment world, the retirement world. We can help with that. So contacting us is easy. We have a team email that we use. So if you'll send an email to this address, we all get copied on that, and one of us will respond quickly to you. You can also go to our website, and we have a partnership link there, and you can click the let's see if we're a good fit, and you can contact us that way as well. So our goal is to get back to you quickly. We try to get back as soon as we can, and especially within a day. So that is all I have today, but were there any questions that we got through the presentation that I can answer?
We do have some questions, Jennifer. Great job. Great stuff too. I love the real world examples of that. So, low hanging fruit, there's been a few that I just saw in the chat asking about like how you charge for things, or, what do you do for your planning part? How does that work? So let's tackle that and we'll get into some of the other questions.
Sure. Yeah, we charge for the assets under management piece. And so that's where, when we come in and provide this extra knowledge for your clients on the estate planning or the cash balance plan, you can charge for the planning fee to the clients, because we're not going to charge the clients directly. I mean, they're going to pay the assets under management like they would anytime they're using a financial advisor, but it's not like they're writing a check to us. So we want you to collect that fee, and then we get paid on the back end from the assets or the insurance.
Perfect. Okay, so first question, in your experience, what's the greatest amount you're able or you've been able to defer?
We had one plan that was almost $1 million. They had quite a few employees, so it didn't all go to the business owners, but we usually don't do the plan unless the business owners keep at least 90%, and usually it's closer to 95%. So the business owners still kept a good amount, but they were able to get a huge tax deduction.
Great. The next one is, how is a business affected in my client's situation? I guess they had a good year in 2024, sole shareholder in 2025. There'd be three shareholders. The previous owner is now 80%, and the two new owners are 15% and 5%.
So is the question, can they still do the cash balance plan?
It looks like it. And
Yes.
Don, if you have a more detail you can give us, please do.
They can definitely continue the cash balance plan. We may have to add, well, we would have to add the other owners in, but it would still be, it's a pooled account. So each employee gets their own allocation within the cash balance plan. So that second year, the first owner wouldn't get 100% of the contribution, it would be split, but they would still be able to get the tax deduction on the business return and still have money for their retirement too.
Okay. Next one, you might have covered this, but it's probably good to go again because I'm sure some are thinking it. Can the insurance exit strategy, buying it out at a discount, be possible for high net worth clients with a W-2 job and no business? I would think they'd have to have a business.
Yeah, you have to have a business for the cash balance plan because that's who's getting the deduction is the business. So unfortunately, if it's a W-2 from outside employment, it doesn't count. Um, if they can start a business on the side, they could, but they would have to pay themselves a W-2 from their new business. It can't be just the outside employer.
Okay, the next one is if we have five employees, including two shareholders and an S corp, do we need to implement the CBPP for all five employees, or can we only do it for the shareholder employees that are shareholders?
It doesn't have to be all of the employees. I believe it's 40%. Our actuaries do the actual calculations on that part of it, but I think it's 40% of the employees have to be covered. And so we would be able to minimize how much went to employees, but some would have to go to employees who are not the owner.
Okay. Um, Next one is the life insurance policy income the death benefit, or is it the amount they can take out as tax-free loans against the cash value during the life of the policy?
Both. I mean, we're looking at when they buy it out in year 5, we usually like them to hold the policy for a few more years before they start taking cash out. But there's not a restriction. So they can do the loans from the cash value as soon as they want. And then eventually they will have a death benefit that will also be tax-free income. But we do look at the income during their life. That's really what we're focused on.
The next one is, can a key man policy work for the S corp? Obviously, I think after that last answer.
Yeah, no, it's really because if the C corp is paying its own tax, then they've paid 21% on those earnings, and then they can use that to fund the policy. The the flow through wouldn't really work because there's not that second tax. So really it's the C corp pays the tax, you can use those funds to fund the policy, and then the person can buy it out after year 5.
Okay, the next one is for the key man insurance, the key man's health would be a factor.
Yes. Yes. Anytime we're using insurance, they do have to be insurable. It doesn't always have to be a great rating. We've seen on the cash balance plan, we've seen some come back that were not great ratings, and it still made sense when we ran the numbers just because there is so much tax efficiency using that discount. But they do have to be able to qualify for life insurance in general. Yes.
Okay. Is there an annual minimum the business needs to contribute to the key man policy?
No, that one's flexible. The cash balance plan, we like to use 100,000 as the minimum because you do have to pay actuaries and the TPA to keep all the records and do all the filing and the compliance. So there is a cost associated to a cash balance plan. But the key man policy, there's not a cost. I mean, you have the cost of insurance just like you would in any policy, but it's not a qualified plan. So that one's really a lot more flexible on how much you fund and also timing. Because even though we're saying 5 payments, it doesn't have to be 5 payments of 100,000. You could even minimally fund it for the first couple years and then backfill it in those last years before you buy it out. So there's a lot of flexibility with the key man.
Okay. Have you ever seen the use of life insurance backfire due to like interest rate changes?
Not interest rate changes. I think the only thing is if the plan ends before the 5 years, it's not as efficient. We really want to be able to fund it for 5 years before we buy it out. So if they end the plan, say in year 2, which actually we have this situation happening right now. We have one client where they funded 2 years at this point, and now their business is getting bought. And so they're not selling the cash balance plan with the other assets. What we're going to do is roll it into a profit share plan. They're creating a new business. We're going to put that into a profit share plan, and then they can use the rest of those funds in there to fund the life insurance, even though they're not going to continue to fund the cash balance plan. So there are some workarounds, but if they really are only funding it for 2 years and then shutting it down, we would want to make sure that we talk to the client ahead of time and make sure that that's not the plan. Or if it is the plan, we would not do life insurance in the cash balance plan.
Okay. What does the Keyman policy buyout look like on a C Corp's tax return?
Um, it's really not a taxable event because they're purchasing the policy for fair market value. So they're putting cash into the business and they're taking out the policy of equal value. So it really is not I don't know if you have to disclose that on a tax return or not, but there wouldn't be an actual taxable event from it.
Next one's kind of a two-part because they kind of go together for two different questions. Is there a minimum net income on an S corp that the cash balance plan yields benefits? And to that, what kind of clients do you look for? Is there like a minimum net worth that you prefer?
So for the income, I would say the minimum would be 100,000 because we can't go negative with the cash balance plan. So if they had an income of 100,000, we funded the plan 100,000, it would zero out the income. So that would probably be the minimum. But if people have income outside of that, or if they had what was the second part of the question? Sorry.
The second part was what you look for. Like, is there a threshold or a minimum net worth you at Baker Wealth like to work with?
Okay. So I think they're asking separate. So for the cash balance plan, it's 100,000 is what we want them to be able to fund minimally into a cash balance plan each year. For our clients that we manage their assets, usually we manage 250,000 and more of assets. That's not a hard number, but that's just usually if people don't have that level of assets, there's not a whole lot of extra planning we can do.
Cool. Is the life insurance policy income, the death benefit, or the amount they can pull out as loans tax free? I think we already answered that one. I'm just going back through the chat to see if there's any that were missed. And some of you asking, yes, the recording will come out. Jennifer, they're wondering if they can get this presentation as a PDF. I mean, imagine you could send that over to us and we could get that out, right?
Sure. Yeah.
Okay, awesome. If you have any other questions, guys, please put them in the Q&A. We did have one come here. Can you explain the discount part of taking the money out of the Keyman life policy after 5 years? Why is it a 40 to 50% discount on that slide? And if you can, show that slide again when you explain.
Sure. Okay, so here's the slide, and the 40% was just an estimate. It's roughly the cash value at the time. There's the insurance company does a whole valuation, it's the perk value. So it's not exactly the same, but just as an estimate, we use 40%. The reason is because we're accelerating as much of the expenses as we can into the first 5 years. Pacific Life actually came out with a product designed around this idea. So it's specifically designed for that 5 year period. So the expenses are accelerated into the first 5 years. The growth is delayed because it's following the S&P over a 5 year period. So it gets credited at the end of the fifth year. So during that fifth year, you've taken most of the expenses for the policy, you've received none of the growth. So it's just a depressed value in year 5. Eventually, the policy is going to continue to grow. Once the person owns it personally, there's very low expenses in the policy at that time. So the cash value can just continue to grow. And the S&P 500, that 5 year index, they get 110% participation for whatever the S&P does over that 5 year period. So it's a really good way to have tax-free growth with low expenses after they buy it out. And for anybody that's not familiar with IUL, which is what we're using here, there's always a 0% floor. So they have a 0% floor, and then on the upside, as long as the S&P performed, they get 110% of that 5-year value.
And the expenses you're referring to with this are just like fund expenses, things like that.
Yep. Inside a permanent insurance policy, you're going to have cost of insurance, you're going to have administrative expenses. There's a lot of expenses that are normally in most IULs, it's over a 10-year period is what the insurance company kind of front loads those expenses. So in this one, they just consolidated it even further. And so most of the expenses are in the first 5 years. But what happens is we found that long term, the client is actually better off by accelerating those expenses in the first 5 years. So it's definitely not a detriment to the client to do it that way. It just means that it's a long term play for the insurance. That's not something that they're going to put the money in and then the next year they're going to see that return. It's going to be a longer term strategy on the insurance.
Got it. Okay. I think we've gotten through them all, guys. If there's any other questions that you do have, please put them into the Q&A or the chat, and we'll get those answered. We have a little bit more time, so we can give that to you. A question on the forefunding of expenses. Forefunding of expenses to help with valuation at 5 years.
Yes. Yes. We're trying to depress that value in year 5. So that's how we get the biggest discount buying it out.
Okay. Keep them coming. Any others, guys? I want to make sure we answer everything for you. Can the LI work for a Schedule C owner?
Yes, you can do a cash balance plan. You wouldn't be able to do a key man policy, but you could do the cash balance plan on Schedule C, get that deduction, use the money to fund the life insurance.
All right. So the only vehicle to fund the cash balance plan is life insurance.
No, we fund the cash balance plan. Part of it goes to investments and part of it goes to life insurance.
Okay. And typically, what type of investments?
It can
Does it
be
vary?
whatever we invest. We have an AI strategy that we like to use for growth, and then we
Okay.
have a direct lending strategy we like to use for consistent returns. The direct
Okay.
lending is returning about 10% right now with no market or low market correlation. It's just interest payments from loaning money out to different corporations. So we
Hmm.
usually do a mix there to keep the fund stable, but also have some going for more growth. But that's a conversation with the business owner. We can tailor that however they want it invested.
And I think in this case they'd already be there, but I take it they have to be accredited to do those type of private lending, stuff like that.
No, those aren't accredited investments. Those are
Okay,
just,
good.
neither one of them. The direct lending, they can put $5,000, $10,000 in if they want. There's not a minimum.
Great. Okay. Anything for a two-person partnership with no employees?
Sure, the cash balance plan would be great.
Okay. Cool. Any other questions, guys? You guys got some good ones today. And if everybody can see, I know the team has dropped the link. If you want to schedule a call with Jennifer and her team just to talk through anything further, maybe you've got a couple clients that you think might fit, but you have some questions, you can grab a time at that link. So just scroll up in the chat. You should see that. Let's see here. Can you have a cash balance plan with no payroll?
If you're Schedule C, then everything would count because it's whatever income is subject to self-employment tax. Those are the rules for what qualifies as wages, because the way that the actuaries determine how much you can contribute is wages and age. I think there's a few other things in there, but those are the major ones. So if you have an S corp, you're going to have wages. That's the only thing we can use. We can do an off calendar year if you have someone for 2024 who has a large tax liability and they did not run payroll, we can do an off calendar year as long as they fund payroll by probably July 30th would probably be the cutoff that we would want to do. they can do the payroll and we can use that calendar year, that off calendar year for the cash balance plan and still take the deduction on the 2024 return. So even if they don't have payroll, we can still help them.
Awesome. How can partners qualify if they can't be on payroll?
We can either use W-2 income or guaranteed payments or whatever they're paying self-employment tax on. So I know the K-1s for partnerships are a little tricky as far as I feel like there's different ways that they can, some of them are subject to self-employment tax, some aren't. So it's whatever payments are subject to self-employment tax for partners, that's what we can use.
Um, Another one, K1 income for general partners will likely be self-employment tax. I think Angie was just stating that. Um, so partners have to be general partner because they are the self-employment taxes. Is that right?
Um, I'm not super familiar with how partnerships are taxed as far as are they not able to get a W-2 on a partnership?
Typically, if they're just getting a K1 as part of the partnership, and maybe they're invested in the business but not working on it, I think like even like maybe they're investing like an oil and gas or something like that, right?
Oh,
Like in a
right. Yeah,
K1.
that would not count for income. It's got to be, it would have to be a partnership. I guess I'm thinking more like a law firm. You know, a lot of times those will be
Mhm.
partnerships and we can use the income that's subject to self-employment tax for cash balance plans. But if it's like a oil and gas and you're just getting a limited partner K-1, then yes, that would not be something we could
Yeah,
use.
and I think that's what they're saying is they need to be like more general partners with,
Right. Yes, then
yeah.
that would make sense.
Can you take a policy loan to the CBP to purchase assets prior to purchasing the policy personally? Would this decrease the buyout?
Um, I don't think you can do loans from the cash balance plan. You can usually do loans from 401ks, but I don't think that you can do a loan from the cash balance plan. So it would have to be funds that you have outside the plan that you would be able to put in. And we go through that. Usually we open a brokerage account outside of the cash balance plan for the business owner so that they can start saving for that.
They're saying a loan from the IUL to the CBP, not the taxpayer. Man, you guys are on fire
Hmm.
today. Good stuff.
I guess since the cash balance plan owns the life insurance, they might be able to take a loan, but I don't know that that would be helpful. Because then if they're buying it out, they would need to repay it before they buy it out.
Hmm. Let's see. This has started a conversation, right? So would you just continue to loan money to the entity? Contribute money to the entity, I guess.
You would keep contributing to the cash balance plan.
I think that's what they're saying is the entity's the cash balance plan. Alexis,
Maybe
if there's any more detail there, go ahead.
contribute the loan proceeds.
So contribute the loan proceeds.
I'm not sure. We might have to take this question
Hey, you know what,
offline.
Alexis? That's a great thing. Book a meeting with Jennifer and team. You guys can talk it through, right? Sounds like that was a very specific
Yeah,
scenario.
we have
So
not done that. I'm not saying it can't be done, but we may need to kind of move some puzzle pieces around and try to figure out how to make that work.
awesome. Uh, all right, so we guys, we are at the end of the time. You guys did great questions today, and like we talked about, this recording will come out. Jennifer, thank you so much for graciously sharing all of the slides and everything in a PDF. We'll get that out to everybody too. And thank you all of you guys for great questions today. Real, like I said, I thought you guys would really love these topics. There's some really great opportunity here, and so hopefully you guys can take advantage, book some time with Jennifer and her team, and see if there's something there. But Jennifer, thank you so much for coming on today and sharing all of this wisdom and insight around this.
One last thing, Dave, for everybody who's part of Tax Plan IQ, we do have the strategies in the portal, so you can look it up.
Mhm.
There's some other webinars and some blogs and some other resources in the Tax Plan IQ portal. So make sure to go there and look too.
So look at you. Great point. Doing my job for me. Sell them the Tax Plan IQ. No, that's
That's
great.
right.
Thank you so much, Jennifer. And guys, yes, check that out. So awesome. All right. Have a wonderful rest of your day, everyone, and a great rest of your week.
Thank you.
Bye.